Jeremy Grantham, one of the most legendary investors on Wall Street, who is arguably in the ranks of Warren Buffett, Charlie Munger, and Ray Dalio, has just come out with some extremely harsh and detailed reasoning as to why he believes we are currently in an epic market bubble. Today I will cover the main points of his most recent publication, Waiting for the Last Dance, and also talk about why, as Warren Buffett puts it, you should be fearful right now as an investor, so stay tuned. Hi everybody, welcome back to The Contrarian. For those of you who are new here, my name's Logan. I really like to talk about overall success in investing and most of all going against crowd thinking mentality within the investing world and elsewhere. So if you like these kinds of topics, just consider subscribing. And I also will make a disclaimer that I'm not a financial advisor, so don't take any of this as personal financial advice. And first of all, to begin with, I want to make it clear how big of a deal this is for Jeremy Grantham to be saying this. Jeremy Grantham, for those of you who don't know, he's a long-term investor and strategist and the co-founder of GMO. He co-founded it in 1977, so he's been around for a long time. He's a very experienced and seasoned investor. He's been through a lot of market cycles. He's seen a lot of bubbles pop in the past, so he's not one of these kind of newbies or come-by-night investors who are out there just trying to get attention. He's a very well-seasoned investor. He's fairly old, kind of like Warren Buffett. He's been through a lot of market cycles. And this is also not going to be an exhaustive reading of his entire article. I'm just going to, pull out some sections that I think really do summarize his main points. So we'll start out with the basic summary of his entire article. The long bull market since 2009 has finally matured into a fully fledged epic bubble, featuring extreme overvaluation, explosive price increases, frenzied issuance, and hysterically speculative investor behavior. I believe this event will be recorded as one of the great bubbles of financial history, right along with the South Sea Bubble 1929 and 2000. These great bubbles are where fortunes are made and lost, and where investors truly prove their mettle. For positioning a portfolio to avoid the worst pain of a major bubble breaking is likely the most difficult part. Every career incentive in the industry and every fault of individual human psychology will work towards sucking investors in. But this bubble will burst in due time, no matter how hard the Fed tries to support it, with consequent damaging effects on the economy and on portfolios. Make no mistake, for the majority of investors today, this could very well be the most important event of your investing lives. Speaking as an old student and historian of markets, it is intellectually exciting and terrifying at the same time. It is a privilege to ride through a market like this one more time. So to begin with, he really focuses on a lot. His first major point is that this is an epic bubble. It's in the ranks of these past major bubbles that we would look back on and think, this could never happen again. The Great Depression crash of 1929, the dot-com crash of 2000, these things would never happen again. But according to Jeremy Grantham, that is what is actually currently happening. Also, just what I like to focus on with investor psychology and avoiding following the crowd is what Grantham is really focusing on here. And just how tempting it will be, and how tempting it currently is for investors to get sucked into the market right now. Just every sort of fear of missing out and following the crowd is wanting to lead you down that path, but he really focuses on, you have to think for yourself. And also he apparently believes that the Fed cannot prevent this kind of crash from, occurring. I know that a lot of people out there think that the Fed could basically buy everything and backstop everything to prevent such a crash from happening. But apparently, Jeremy Grantham is not in that category. He does not believe the Fed has unlimited buying power. I would also agree with that to some extent, just simply because the Fed cannot. They never, are looking forward. They're always reacting. So if such an abrupt crash were to happen, there would just be no way they could respond in the amount of time that it would be needed. They would have to respond instantaneously, if not, preemptively, actually, before the crash. So there is just no way they could backstop such a crash as that. Let's read on. How are clients to tell the difference between extreme market behavior and a manager who has lost his way? The usual evidence of talent is past success, but the long cycles of the market are few and far between. Winning 2 of 2 events or 3 out of 3 is not as convincing as a larger sample size would be. Even worse, the earlier major market breaks are already long gone. 2008, 2000, or 1989 in Japan are practically in the history books. Most of the players will have changed. Certainly the satisfaction felt by others who eventually won long ago is no solace for current pain experienced by you personally. A simpler way of saying this may be that if Keynes had really said, the market can stay irrational longer than the investor can stay solvent, he would have been right. I am long retired from the job of portfolio management, but I am happy to give my opinion here. It is highly probable that we are in a major bubble event in the U.S. market, of the type we typically have every several decades, and last had in the late 1990s. It will very probably end badly, although nothing is certain. I will also tell you my definition of success for a bear market call. It is simply that sooner or later there will come a time when an investor is pleased to have been out of the market. That is to say, he will have saved money by being out, and also have reduced the risk of volatility on the round trip. This definition of success absolutely does not include precise timing. Predicting when a bubble breaks is not about valuation. All prior bubble markets have been extremely overvalued, as is this one. Overvaluation is a necessary but not sufficient condition for their bursting. Calling the weak month or quarter of the top is all but impossible. So here Grantham really talks about how, this is probably, we're probably in a market bubble situation similar to these past, historical bubbles that we look back on. But also it's just so impossible to predict when these bubbles will pop. Certain people like to say that they were able to predict, when the housing market bubble burst or when the dot-com bubble burst. But oftentimes it's just really... Oftentimes they had been saying that for the last several years, and then they said it, the week before it ended up bursting. So it is just really, really difficult, if not impossible, to predict when a bubble will pop. But yeah, let's read on. He really goes into the details of why he believes this is very overvalued. The Buffett indicator, total stock market capitalization to GDP, broke through its all-time high 2000 record. In 2020, there were 480 IPOs, including an incredible 248 SPACs, more new listings than the 406 IPOs in 2000. There are 150 non-microcap companies, that is, with market capitalization of over 250 million, that have more than tripled in the year, which is over 3 times as many as any year in the previous decade. The volume of small retail purchases of less than 10 contracts or call options on U.S. equities has increased 8-fold compared to 2019, and 2019 was already well above long-run average. Perhaps most troubling of all, Nobel laureate and longtime bear Robert Shiller, who correctly and bravely called the 2000-2007 bubbles, and who is one of the very few economists I respect, is hedging his bets this time, recently making the point that his legendary CAPE asset pricing indicator, which suggests stocks are nearly as overpriced in the 2000 bubble peak, shows less impressive overvaluation when compared to bonds. Bonds, however, are even more spectacularly expensive by historical comparison than stocks. Oh my. So I'm not at all surprised that since the summer the market has advanced at an accelerating rate and with increasing speculative excesses. It is precisely what you should expect from a late-stage bubble, an accelerating, nearly vertical stage of unknowable length, but typically short. Even if it is short, the stage at the end of a bubble is shockingly painful and full of career risks for bears. I am doubling down because as prices move further away from trend at accelerating speed and with growing speculative fervor, of course my confidence as a market historian increases that this is indeed the stage of a bubble. A bubble that is beginning to look like a real humdinger. So yeah, he really lays out a lot of fundamentals there for why just this is such an outsider in terms of past statistics regarding the market. Just the Buffett indicator being at an all-time high, but then all these really, really bad signs of IPOs, all these new SPACs, all this speculation going on in the market. It just really doesn't bode well. And now he goes on to talk about more of the speculative and investor psychology behind bubbles. And this is what I really like to focus on my channel is investor psychology and how you as an investor can avoid these kind of common traps that investors fall into, and most of all avoid following the crowd. Because if you want to beat the market, if you want to beat the crowd, you have to go where the crowd is not going. And that's just a fundamental rule of beating the market. So let's read on. All bubbles end with near universal acceptance that the current one will not end yet, because in 1929 the economy had clicked into a permanently high plateau, because Greenspan's Fed in 2000 was predicting an enduring improvement in productivity and was pledging its loyalty or moral hazard to the stock market, because Bernanke believed in 2006 that U.S. house prices will merely reflect a strong U.S. economy, as he perpetuated the moral hazard. If you can win, you're on your own, but if you lose, you can count on our support. Yellen and now Powell maintained this approach. All three of Powell's predecessors claimed that the asset prices they helped inflate or in turn aided the economy through the wealth effect, which effect we all admit is real. But all three avoided claiming credit for the enduring market breaks that eventually followed, the equity bust of 2000 and the housing bust of 2008, each replete with the accompanying anti-wealth effect that came when we least needed it, exaggerating the already guaranteed weakness in the economy. This game surely is the ultimate game with the devil. So yeah, he goes on to say how, again, we're at all-time highs, we're at, the fundamentals are not there for the economy and the stock market to be doing this well, and the economy is actually not doing well. But yeah, it's just, he goes into why, as bubbles get near the peak, that investor sentiment just is so wrong. People just end up making up these reasons as to why, the market, why they think the market will continue going higher, and just these really nonsensical reasons that don't make any sense. And just recently, there's been so much of that going around on Wall Street right now. Just how current claims that technicals have overcome fundamentals, or the Fed can backstop anything and they'll buy anything if it crashes, so just continue to buy the dip. I just see so much of that same investor sentiment out there right now. So let's go to the end where he finishes up. So here we are again. I expect once again for my bubble call to meet my modest definition of success. At some future date, whenever that may be, it will have paid for you to have ducked from midsummer of 2020. But few professional or individual investors will have been able to have ducked. The combination of timing uncertainty and rapidly accelerating regret on the part of clients means that the career and business risk of fighting the bubble is too great for large commercial enterprises. They can never put their full weight behind bearish advice, even if the PE goes to 65 times, as it did in Japan. The nearest any of these giant institutions have come to offering fully bearish advice in a bubble was UBS in 1999, whose position was nearly identical to ours at GMO. That is to say, somewhat brave and foolhardy. Luckily for us, they changed their tack and converted to a fully invested growth stock recommendation at UBS Brinson and its subsidiary in February 2000, just before the market peak. This took out the 800-pound gorilla that would otherwise have taken most of the rewards for stubborn contrariness. So he's basically saying that it's going to be very rare for investors to see this coming and to wait and to have the patience to wait. But obviously, if you know me, I like going against the crowd. It's the only way you can really beat the market, so I really encourage you to just think for yourself at this point in time and to heed Jeremy Grantham's words and take them with put a lot of weight to them because he's a very experienced investor. So this is Jeremy's take, and I put a lot of weight behind what he says. He's not just some YouTuber clickbait creator, and he's not some inexperienced trader. Again, he's had 40 plus years of experience on Wall Street, and he's seen the extent that market euphoria and crowd thinking can override, sound investment thinking. And this is the kind of situation you as a contrarian investor should be fearful in, according to a famous quote by Warren Buffett, which is, be fearful when others are greedy and greedy when others are fearful. And in the past few months and accelerating until recently, I cannot explain how quickly investor sentiment has shifted from caution to indifference and now to full-fledged euphoria or greed, as Warren Buffett would put it. And yeah, you don't have to look far to see all of these headlines of how you need to get into equities now. Just buy is the message out there by basically all the investing media, and the crowd of investors who've been sitting out for the last 9 months are finally jumping back in. So yeah, just look at this headline of Jim Cramer saying you need to get into equities. Same with Chamath Palihapitiya and CNBC and Bloomberg and Market Insider, and YouTubers are all going wild with enthusiasm. But now is not the time to follow the crowd. In fact, if you want to beat the crowd, you never want to follow the crowd. And so be what Warren Buffett told you to be, which is fearful, which is his way of saying be very cautious at this point in time. Don't let your emotions or fear of missing out get in the way of making sound decisions. The truth is that there are still some very real concerns that the market and crowd of investors is ignoring. As Grantham just laid out, the fundamentals for another bull market aren't there, and rather the fundamentals for an epic crash are currently there. So you could potentially stay in a little longer and make it big in the coming weeks. It could continue to run up even more, but if you do stay in more, you should really be ready to get out very quickly if you see that it's starting to crash. It very well could be a very short-lived market run-up before an epic crash. This is, the major points of Jeremy Grantham's Waiting for the Last Dance that I wanted to share with you, and also just, encouraging all of you guys out there to think for yourself and to not get led astray by the crowd of euphoria that's going on out there. So, if you guys like these kinds of topics, just consider subscribing, and I hope to see you again.